The final hours of this trading day have been particularly dramatic for Opendoor Technologies, Inc., with the stock closing at a price of $9.16. This represents a staggering loss of 12.88% on the day, a brutal reversal from the bullish sentiment that has defined its recent performance. While many investors are conditioned to see such a steep decline as a sign of underlying weakness or a catastrophic event, a deeper look reveals something far more nuanced and, for the astute investor, potentially more insightful. This wasn't a failure of the business model or an earnings miss. It was a market-wide liquidity flush, a moment where the expectations built up around a highly speculative stock collided with the cold, hard reality of profit-taking and institutional rebalancing. The swiftness and severity of the drop, coupled with an unusually high trading volume that reached nearly 300 million shares, points to a clear and deliberate unwinding of leveraged long positions, likely initiated by sophisticated traders who recognized that the stock's parabolic ascent had become unsustainable. It's a classic case of the fast money getting out, just as retail investors, buoyed by the recent narrative, were still piling in. The prevailing narrative around Opendoor has been one of a stunning, almost unbelievable turnaround. Just a few months ago, the company was trading for mere cents, facing a looming delisting notice from Nasdaq and battling the perception that its iBuying model was fundamentally broken in a high-interest rate environment. Yet, over the last few months, driven by a potent mix of new leadership, a strategic pivot, and a renewed wave of meme stock fervor, the stock has skyrocketed. Analysts and retail investors alike have been caught in a head-spinning rally that has seen the stock reach a new 52-week high of $10.70 just yesterday, a feat that felt impossible just weeks prior. The expectation was that this momentum would continue, fueled by the narrative of a leaner, more resilient Opendoor and the promise of a potential return to the board by its visionary founders. The reality is that this rally was built on extremely shaky foundations, a house of cards constructed from retail enthusiasm and the short-term dynamics of a short squeeze, rather than a fundamental shift in the company's profitability or a significant improvement in the housing market's macro environment. The expectation was that a new CEO and a few strategic tweaks would magically fix the company's core issues. The reality is that the iBuying model remains capital-intensive and highly sensitive to external economic pressures. Examining the recent stock movement, the intraday chart for Opendoor tells a story of a day-long capitulation. The stock gapped down significantly at the open, immediately erasing a large portion of yesterday's gains. This initial shock was followed by a series of cascading sell-offs, punctuated by brief, failed attempts at recovery. The heavy volume indicates that this wasn't just a few timid investors selling, it was a significant redistribution of shares. We're seeing institutional players reducing their exposure, while day traders and momentum chasers are getting caught in the downdraft. The stock's journey from a 52-week low of just over 50 cents to its recent high was a spectacle, but it was not a reflection of a sudden business renaissance. The key catalyst wasn't a massive earnings beat or a game-changing acquisition. It was the confluence of a high short interest, a strategic announcement about a new CEO, and the potential return of its founders, and the powerful coordinated buying of retail investors, often organized through platforms like Reddit. For a long-term investor, the fundamentals were never strong enough to support such a rapid price increase, which is precisely why this sudden and severe correction was always a possibility, if not an inevitability. It's a reminder of the fragility of narrative-driven rallies when they're not backed by consistent, profitable operations. This is where the core of investment help and self-investing comes into play. It's about understanding the difference between a speculative frenzy and a legitimate growth story, a distinction often lost on those caught up in the excitement. Firms like Schwab Intelligent Portfolios and Fidelity Investments often preach this discipline, guiding their clients away from such volatile situations and towards more stable, fundamentally sound opportunities. Beyond the daily swings, it's crucial to understand Opendoor's business model to grasp the long-term challenges. Opendoor, a pioneer in the iBuying space, aims to transform the residential real estate process by buying and selling homes online. Their primary business model involves making instant all-cash offers to homeowners, taking on the inventory risk, and then relisting the homes after performing minor repairs. This model provides sellers with speed, certainty, and convenience, but it also exposes Opendoor to significant market risk. When the housing market is hot, with rapidly appreciating prices, the model can be highly profitable as the company can turn over inventory quickly at a gain. However, in a cooling or declining market, the very environment we find ourselves in with persistent inflation and high mortgage rates, the model becomes a liability. The company is forced to hold depreciating assets, leading to inventory losses, widening net losses, and a significant cash burn. Their recent strategic shift towards a capital-light model, which involves partnering with real estate agents to facilitate transactions, is a clear attempt to de-risk the business and generate more stable fee-based revenue. While this is a step in the right direction, it's an acknowledgement of the inherent fragility of their core model, not a magic bullet. This strategic pivot is a sign that even the company recognizes the need to diversify away from its capital-intensive foundation. Opendoor's financial performance has been a roller coaster. They have historically been unprofitable, a common theme for high-growth tech companies, but their losses have been exacerbated by the macroeconomic climate. While their Q2 2025 report showed some signs of improvement with a narrowed net loss and positive adjusted EBITDA, these gains were overshadowed by a significant decline in home acquisitions and a warning about lower volumes for the second half of the year. The company's balance sheet is a key concern, with a high total debt-to-equity ratio, indicating a heavy reliance on leverage to fund its operations and inventory. For any online investing enthusiast looking at this company, these are the critical red flags that should not be ignored. It's not about the flashy headlines or the stock's recent performance on an app like Robinhood, which often emphasizes quick gains. It's about the underlying financial health, the path to profitability, and the resilience of the business model in a challenging market. Even with the new CEO, the company's fate remains tied to the broader real estate market, and the current forecast for that market is far from a clear path to recovery. Looking ahead, the future outlook for Opendoor is a study in contrasts. The bullish case rests on the idea that the company has now weathered the worst of the housing market storm and is on the cusp of a significant turnaround. They have a new leadership team, including the return of its founders, which is seen as a vote of confidence in their ability to steer the ship. Their capital-light strategy could provide a more stable revenue stream and reduce the company's reliance on a volatile housing market. If interest rates begin to fall and home sales volumes rebound, Opendoor's model could once again become highly effective, and the company could rapidly scale. On the other hand, the bearish case is more grounded in the immediate reality. The company remains deeply unprofitable, and there's no clear timeline for when that might change. The housing market is still under pressure, and the transition to a new business model is a slow process that will take time to bear fruit. The stock's recent price action, driven by a short-term frenzy, has created a significant disconnect between its valuation and its underlying fundamentals. It has now fallen into a dangerous limbo where its future hinges less on its operational excellence and more on the unpredictable whims of retail sentiment. It's this tension between the narrative of a triumphant comeback and the reality of a business still grappling with existential challenges that defines the investment thesis for Opendoor. Before we conclude, I want to ask you, the viewer, do you think Opendoor's new leadership can successfully navigate the current real estate headwinds and put the company on a consistent path to profitability? Comment below with your thoughts on the company's long-term viability. This isn't just about picking a stock, it's about evaluating a business and its potential to survive and thrive. Many are using platforms like SoFi Invest to access these volatile stocks, or even interactive brokers for more sophisticated trading strategies. But regardless of the tool, the fundamental analysis remains the same. The Opendoor story is a powerful illustration of the friction between market expectations and operational reality. The recent price action, while painful for those who bought at the peak, was a necessary recalibration.
It's a stark reminder that even the most compelling narratives and the most powerful short squeezes will eventually be measured against the cold, hard numbers of revenue, profit, and loss. The real challenge for Opendoor isn't just fixing its business model. It's convincing the market that it has the staying power to get there, and that's a much harder sell after a day like today. The company's journey forward is less about a sprint, but more about a marathon, a long and arduous path to prove its worth. The expectation was a continuous rally to the moon. The reality is a steep descent back to earth, a necessary correction that separates the speculators from the true investors.